Hello and welcome to the first ever RWinvest vlog. Today we're going to be taking you through the basics of buy-to-let investment property. My name's Craig Knight and I'm one of the senior sales managers here at RWinvest and have been for the past 5 years. And today I'm here with my colleague.
Hi, I'm Lewis Vernon. I'm one of the investment consultants in the head office of Liverpool for RWinvest. I've worked here for 2 years and I will assist investors with their property journey.
So I suppose, Lewis, before we get started, as this is a beginner's guide after all, we should probably define what buy-to-let is, what the term buy-to-let actually means. In a nutshell, if you would.
Yeah, so it's essentially someone looking to invest in a property to use it to generate income, basically, rather than to live in it.
Fantastic. So they're looking to buy it, they're looking to rent it out, and they're looking to make some money from it. Okay. Now, what would you say if you were giving advice to a first-time investor, somebody who has never done this before? What is the first thing they need to establish before they get started?
It's got to be the reason as to why they're investing as an individual, because everyone has different reasons for investing, of course. So some people do generally focus on yield. Some people might focus on appreciation. Some people might want to focus on, a mixture of both. So establishing what they're looking for what their reason for investment is from the start will get them the best outcome.
Okay, so you're trying to figure out what's motivating them and what they need out of the investment. Do they need appreciation? Do they need yield? And again, as this is a beginner's guide, we should definitely define some of those key terms. So when we talk about yield, we mean the percentage return you get relative to the value of the property. So to use an example, a property that was £100,000 with a 5% yield, that property is bringing in £5,000 per annum as profit for the investor.
Yeah.
And then when we talk about capital appreciation, we're talking about how much the money you put in goes up in value over a set term. So if a property goes up from 100,000 to 120, we're saying £20,000 capital appreciation.
Yes.
Fantastic. Okay. From experience, Lewis, what type of investor would you say might focus on yield and what might focus on capital appreciation? Are they different? Do some people tend to focus on one more than the other?
Yeah, I would say in my experience generally, it's more people, for example, who are looking to invest maybe parts of the pension or the short-term gain would focus on yields because obviously they want to generate the highest return in a short period of time. People who normally focus on appreciation are generally in it for the longer run, obviously, because that's when you tend to see the higher appreciation with the property. So I would say on average, they're the two sort of separations as to what people look for.
Okay, and then the exception being that investor who might try and buy a property at a really, really good price with a view to selling it quickly, a term coined flipping, and you would get short-term appreciation rather quickly there. So the actual term of the investment can differ as well as the focus.
Yeah, definitely.
Okay.
Okay, so now that we've established what the investor's looking for, what's next on the priority list for them?
It's got to be location. I'm sure you've heard the saying, most of our would-be investors will have as well, location, location, location. It's the single most important factor that will determine the success of any buy-to-let investment property. And with regard to location, the things you need to look for are growing populations. You want a strong rental market, lots of young people looking to rent properties. I personally always look for areas undergoing lots of regeneration and gentrification. If an area is having money spent on it, it stands to reason the prices will go up and the rents will go up. And then one other thing that I always encourage my investors to look for are unique selling points and unique features. Things like, if I was to pick an example, the Superport in Liverpool city centre, that port has 50% of the trade connections with America, which is obviously going to be very important post-Brexit, but that's a subject for another time. The same as Manchester has connections to HS2. Connecting the city to London. Things like that will determine the success of a location you choose to invest in.
Okay, so with that being the case, how can a location, for example, influence an investor who's looking for yield? If they're solely focusing on yield, what would you advise, basically?
Okay, that's a good question. It does have a big impact. Generally speaking, if you have an investor focusing on yield, they're going to want to invest in a location where the average property price is relatively low, relative to the average income you'd get from a tenant. So the Northwest historically has been very, very strong when it comes to yield. And if you were to single out the single best city for rental yields, again, you'd have to say Liverpool. 7, 8% returns on average over the last 5 years. And it does have those affordable property prices, which directly link, as I mentioned.
Okay, so same again. On the other hand, how can how will it influence a capital appreciation for an investor? How can you tie in a location to that?
Again, another interesting question, because this has changed in recent years. Historically, somebody focusing on capital appreciation would go for London all day long. Put your money in, wait a long period of time, the prices would always consistently go up. That's changed of late. And I would say now you can get equally, if not better returns in cities such as Manchester. Again, lots of regeneration, lots of investment, lots of growth. The prices there are booming and have done consistently for the past 5 or 6 years. I mean, it's not unrealistic to see, what would you say, 25% plus appreciation over the last 5 years. Okay, so moving on from location, but in relation to it also, I find from experience that investors tend to fall into that trap of investing close to home. Partly because they feel like they know the area, they know where's good and where's bad, but also because they intend to self-manage the property. Many people don't know that there's actually another way of actually appointing a management agent and having a property managed in a way that we would call hands-off. Can you briefly explain that to us, Lewis?
Yeah, you are right. A lot of our investors don't understand how the hands-off approach works. Essentially, we will set you up with an on-site rent management company who finds your tenants, manage them, collect the rent and pay it to you. They normally charge around 10%, so it is a really good rate, and also they offer you a wealth of experience alongside all of the benefits of you not getting involved.
So that 10%, that's based on the gross rental income that the tenant pays. So if they pay, I don't know, £500 a month, they take 50 and you get 450.
Yeah, exactly. And although they charge that, they will also be aware of what the market rate is. So if the rents go up in the area year on year, you if you self-manage your property, you might be aware of that, because they're assessing the data day in, day out. They know what the best rates are for your property.
It's funny that you should say this, because often when we have a project whereby we might get multiple investors purchase properties, some choose to self-manage and some use a management agent. And it's always interesting to me that after a few years, the ones using the management agent are getting a higher monthly rental income than those self-managing. So for me, I think they're worth their weight in gold and well worth investing in. How would you say that using a management agent influences location and the locations that you can invest in?
Yeah, good question. So, for example, if you're based in London, for example, you're an investor based in London and you want a high yield, you're probably going to be, focusing outside of London, obviously. So it's going to be like maybe the Northwest, and you're not going to want to be doing all the traveling, the management, taking the phone calls. So having a rental management company in place can not only generate you, create you a hands-off investment, but also generate you overall a higher return, and you're not doing nothing.
So it really opens up other locations.
Yeah, most definitely. So what's next?
So now that we've decided upon a location, you really need to decide on a property type. What property are you going to invest in? And generally speaking, if you're focusing on one of the major cities for investment, there's only really a couple of choices when it comes to property type. What would you say the most common ones are?
Without doubt, houses or apartments. They're the number two.
They're the two, okay. If you had a brand new investor inquire with you and say, okay, Lewis, I want to make this difficult for you. I want yield and appreciation, and I fancy maybe, I don't know, let's say Liverpool or Manchester. What property type would you recommend, a house or an apartment?
I would actually recommend an off-plan apartment.
Off-plan, okay, interesting. Now, for those that don't know, remember this is a beginner's guide. Off-plan is a term used for properties which are in the process of construction.
Yeah.
So you're buying them literally off the architect's plans, and they can be at any stage in development, from just plans being submitted, no work on site, all the way to the property almost being ready. So the wait time varies. Generally speaking, if you get in early, you tend to get a better price, is that right?
Absolutely.
The earlier you get in, the better the price you get. And that also ties into the main advantage to off-plan property. It's significantly below market value. So if for example, we were to say, in a particular location, the average property price might be £250,000, completed and ready, what would you say an off-plan property would be marketed for?
You could get 20% below market value, so you could pick that up off plan for 200,000. Yeah.
Okay, interesting. So for an investor looking for capital appreciation, off-plan can be the way to go.
Yeah, and also yield.
And well, of course, because it opens up those premium locations. A couple of other added benefits, I'd say, for me when looking at an off-plan project, is you can quite literally cherry pick the property you want. So whether it's a house or an apartment, you can say, I want to have a particular view, I want to have a particular aspect. Any other advantages you can think of with off-plan?
Yeah, obviously they all do come with a 10-year build warranty as well, so that's something to definitely bear in mind. And of course, long leases, so overall you're getting something which is, I suppose, more hands-off from the moment go with an off-plan property. If you like what you've seen in this video or have any questions about investing, fill out your name, email and contact number in the link in the description below, and myself or Craig will contact you directly to discuss your needs further.